Welcome to MarketTamer.com. You're looking at a chart of the U.S. total credit market debt as a percent of GDP from 1929 through to 2008. And special thanks to Morgan Stanley for providing this. What we can see is back in 1933, we see that the U.S. credit market debt as a percent of GDP is closing in almost around 300%. And this time around in 2008, we see it peak way above that, even above 350%. So for those of you that ask the question, how is it that we can predict when there's going to be a collapse or a correction? The answer is it's very, very difficult, but keeping an eye on leverage ratios is a very key component to understanding when maybe a dislocation has occurred and when excessive debt has been incurred. So for example, if we take a look back in 1933 again, what we can see is there was a disproportionate amount of debt assigned to corporations. We can see that level was around 51%, whereas in the most recent crisis, corporate debt was largely under control relative to the total. If we look at it, it's about 22%. So what got out of control this time around? Well, it's not the government debt if we look just at the blue graph, because the way to analyze this is just note the peak from the 300% line here down to the green area here. It's not actually that much different than it was here in 2008. So that's not the cause. But what does factor in under government sector these days is GSEs. And that is including companies like Fannie Mae and Freddie Mac. And that comprise a much bigger portion. This time around, that jumped up from 24% to 33% when you factor in the GSEs. But more critically this time, we had this huge growth in financials. Note that this wasn't even virtually a blip on the debt percentage relative to GDP back in 1933, but this time around in 2008, financials comprised a huge part of that. And so there was a concentration of risk. If we look to households as well, obviously we see household debt became excessive relative to 1933. However, in both cases it was reasonably large, 18% and 27%. And so we've spoken in the past about some comments from Paul Tudor Jones regarding debt cycles, booms and busts. And effectively what we see is when leverage reaches excessive levels such that affordability decreases, then we find that a contagion occurs in which borrowers cannot afford to pay back loans. We find that asset prices start to decline, and so a spiral downwards manifests, and essentially that takes down the whole system. In this case, it started in the household sector with subprime mortgages, but the contagion spread obviously through the banking sector and beyond, spread globally indeed this time around. So maybe for those of you with a long-term perspective, we just encourage you to keep an eye on this chart more particularly in the future, because this is a really, really critical graph that many people were not paying attention to. Obviously in 2008, we were highlighting the fact that at the beginning of the year it would most likely be a year of substantial volatility. That played out right as expected. We anticipated a huge correction. That played out right as expected. And so for those of you trying to figure out how do you predict these things ahead of time, these were the types of graphs we were analyzing back in 2008, which allowed us project a period of sustained difficulty for the markets. And if you have any questions on what you're looking at here or what the view going forward is, please don't hesitate to join us at MarketTamer.com.